$350 trillion. That is not a typo. 350 trillion. More than 4 times the entire global economy. That is how much money was tied to a single interest rate called LIBOR. Your mortgage, your credit card, your student loan, your car payment, corporate bonds, derivatives, municipal debt, everything. All of it referenced this one number. And that number, the most important number in global finance, was decided every morning by a handful of bankers in London. Except they were not calculating it based on market conditions. They were not using complex algorithms. They were texting each other, offering champagne, promising coffee, and rigging the rate to make themselves richer while you paid more on your loans. This is the LIBOR scandal, the largest financial fraud in history. And it proves something you probably already suspected but did not want to believe. The free market is a lie. There is no invisible hand. There is a cartel. And they have been stealing from you every single day for decades. By the end of this video, you will understand what LIBOR was, how it was manipulated, why regulators knew and did nothing, and what this reveals about every financial system you are told to trust. Because if they rigged this, what else are they rigging right now? Let me start with the basics, because most people have never heard of LIBOR, and the banks like it that way. The more complicated the system, the easier it is to hide the fraud. LIBOR stands for London Interbank Offered Rate. It is the rate at which banks lend money to each other. Every morning, a group of major banks would submit estimates of how much it would cost them to borrow from other banks. These submissions were averaged, and the result became the LIBOR rate for that day. Sounds reasonable, right? Banks need to borrow from each other. The rate reflects market conditions, supply and demand, transparency. Except none of that was true. Here is why LIBOR mattered to you. Almost every financial product in the world was tied to it. Your adjustable rate mortgage, LIBOR plus 2%. Your credit card interest rate, LIBOR plus 5%. Your student loan, LIBOR plus 3%. If LIBOR went up by even 0.1%, millions of people around the world paid more in interest. And if LIBOR went down, they paid less. But here's the problem. The banks submitting these rates were also trading financial products that made money when LIBOR moved in specific directions. A trader at Barclays might have a position that would make millions if LIBOR went down. So what does he do? He messages his buddy who submits the LIBOR rate for Barclays. And he asks him to submit a lower number. Not because that is the real rate, but because it makes the trader money. And it worked. For years. Because the system was based entirely on trust. There was no verification, no audit, no oversight. The bank self-reported. And everyone assumed they were telling the truth. Let me show you what actually happened. Because this is not theory. This is documented. The messages exist. The emails exist. The evidence is public. Tom Hayes, a derivatives trader at UBS and later Citigroup, he made tens of millions of dollars by manipulating LIBOR. And he did it openly, brazenly, because he did not think it was illegal. He thought everyone was doing it. And he was right. Here are actual messages sent by traders to the people submitting LIBOR rates. These are not paraphrased. These are direct quotes from court documents. It would be a huge help if you could keep it low. Done. For you, big boy. Coffees will be coming your way. I owe you big time. Come over one day after work and I'm opening a bottle of Bollinger. Read those again. Your mortgage rate. The rate you paid on your car loan. The interest on your credit card. It was decided by a guy promising another guy a bottle of champagne. That is not a free market. That is a cartel. And you were the victim. The manipulation happened in 2 ways. First, traders would rig LIBOR to profit from their positions. If a trader had a bet that would pay off if LIBOR went down, he would ask his colleagues to submit lower rates. If he had a bet that would pay off if LIBOR went up, he would ask for higher rates. The actual cost of borrowing was irrelevant. The only thing that mattered was whether the trader made money. Second, banks manipulated LIBOR to hide their financial problems. And this is where the 2008 financial crisis comes in, because the LIBOR scandal was not just about greed, it was also about survival. In 2008, the global financial system collapsed. Lehman Brothers failed. Banks stopped trusting each other. The interbank lending market froze. If you were a bank and you needed to borrow money, other banks either refused to lend to you or charged you a massive premium because they thought you might go bankrupt. So what happens to LIBOR in that environment? It should skyrocket, because borrowing costs are through the roof. But if your bank reports a high LIBOR rate, you are essentially admitting to the world that you are in trouble, that other banks see you as a risk, that you might be next to fail, and that creates a death spiral. The higher your reported rate, the more investors panic. The more they panic, the harder it becomes to borrow, and eventually you collapse. So banks lied. They submitted artificially low LIBOR rates during the crisis, not because that is what they were actually paying, but because admitting the truth would have destroyed them, and the regulators knew, the Bank of England knew, the Federal Reserve knew, and they did nothing. because they believed that letting banks lie was better than letting the system collapse. This is not speculation. In 2008, there were emails between Barclays and the Bank of England where Barclays explicitly discussed lowering their LIBOR submissions to avoid looking weak. And the Bank of England did not stop them. In fact, there is evidence suggesting they encouraged it because the priority was not truth. The priority was stability, even if that stability was built on fraud. Let me put this in perspective. Imagine you are applying for a mortgage. The bank tells you that your interest rate is determined by market conditions, by your credit score, by supply and demand. And you believe them. Because why would they lie? But what actually happened is that the rate you got was influenced by a trader in London who wanted to make a bonus, who sent a message to a colleague asking them to move the rate a few basis points, who offered a bottle of champagne in exchange. And the rate moved. And you paid more for 30 years on a loan worth hundreds of thousands of dollars because a guy wanted a bottle of Bollinger. This is not a victimless crime. This is systematic theft. And it happened on a scale so massive that it is almost incomprehensible. $350 trillion in financial products were tied to LIBOR. Even a tiny manipulation, a movement of 0.01%, could shift billions of dollars from borrowers to banks. And the banks knew it. Internal audits at multiple banks flagged the manipulation. Compliance officers raised concerns. Regulators received complaints. And nothing was done. For years. Because the people committing the fraud were the same people, making the banks billions of dollars. They were not punished, they were promoted. Tom Hayes, the trader who sent those messages, was eventually arrested. He was tried in the UK. And in 2015, he was sentenced to 14 years in prison. He served 5.5 years before being released. He is one of the only individuals who went to jail for LIBOR manipulation. Out of hundreds of traders who participated, out of dozens of banks that were involved, the banks themselves, they paid fines. Barclays paid $450 million. UBS paid $1.5 billion. Deutsche Bank paid $2.5 billion. In total, banks paid over $9 billion in fines. That sounds like a lot. Until you realize they made far more than that from the fraud. The fines were a cost of doing business, and not a single executive went to jail. In fact, Bob Diamond, the CEO of Barclays during the LIBOR scandal, walked away with millions in severance. He was never charged. He started a new investment firm. He's still wealthy, still powerful, still respected in financial circles. Because the system does not punish the people at the top. It punishes the people at the bottom. And it charges the victims, you, for the cleanup. In 2021, LIBOR was officially discontinued, replaced by new rates, SOFR in the United States, SONIA in the UK. These new rates are supposed to be more transparent, more resistant to manipulation, based on actual transactions instead of self-reported estimates. But here's the question you should be asking. Are the new rates actually better, or are they just a different version of the same scam? Because the banks that rigged LIBOR are the same banks that control the new system. The regulators who allowed LIBOR manipulation are the same regulators overseeing the new rates. And the incentives, the profit motive, the willingness to lie for money, none of that has changed. Financial systems are built on complexity, and complexity is camouflage. The more complicated the system, the harder it is to detect fraud. LIBOR was complicated. Few people understood it, and that made it easy to manipulate. The new rates are just as complicated, maybe more, and that should terrify you. Because the lesson of LIBOR is not that the system was broken. The lesson is that the system is designed to be broken. It is designed to benefit insiders at the expense of everyone else. It is designed to hide theft behind jargon, regulations, and the illusion of oversight. You are told that markets are efficient, that prices reflect all available information, that competition keeps everyone honest. But LIBOR proves that is a lie. Markets are not efficient when the people setting the prices are colluding. Information is not available when the data is falsified. And competition does not exist when the players are working together. This is not capitalism. This is a cartel, and you are not a participant in the market. You are the product being exploited. So what do? How do you protect yourself in a system designed to rob you? First, assume everything is rigged, every rate, every price, every benchmark. If it can be manipulated for profit, it probably is. Do not trust the official numbers. Do not assume regulators are protecting you. They are protecting the banks. Second, minimize your exposure to variable rates. If your mortgage is tied to an index, refinance to a fixed rate. If your credit card has a variable APR, pay it off or switch to a fixed rate product. The less your financial life depends on rates controlled by banks, the less vulnerable you are to their manipulation. Third, demand transparency. Ask questions. Where does this rate come from? Who sets it? How is it verified? Most people never ask. And the banks count on that. The moment you start asking, you become a problem. And problems get noticed. And finally, understand that the game is rigged. But you still have to play, because opting out is not an option. You need a mortgage, you need credit, you need to participate in the financial system, but you do not have to trust it. And you do not have to pretend it is fair. LIBOR is gone, but the mentality that created it is still here. The traders are still trading, the bankers are still banking, and the next scandal is already brewing. You just do not know what it is yet. Because the system is not designed to be honest. It is designed to be profitable. And as long as lying is more profitable than telling the truth, the lies will continue. The LIBOR scandal was not an anomaly, it was a feature. And the sooner you accept that, the better prepared you will be for the next time they get caught. Here's what I want you to do. Go to the comments right now. Do you think the current interest rates you pay, SOFR, credit card APRs, mortgage rates, are based on real market conditions? Or do you think we are living through another LIBOR scandal that just has not been exposed yet? Write one word: real or rigged. Let me know what you think. And if this video made you look at your loan statements differently, share it with someone who still believes the financial system operates on trust and transparency.